Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler talking money and investing. So, one of the things that has been happening is it's so interesting just to watch how politics and money and finances kind of play together. And that's one of the things I was talking about on TV this past week. I just made the comment about, we were talking about Social Security a lot. Matter of fact, Channel 5, we did this whole thing on Social Security. If you get a chance to check it out, it'll be on my website. Should be on their website too. Actually, News Channel 5 Plus, we did an open line and I talked about Social Security the whole time. Dispelling a lot of the myths, answering some questions that people had regarding that. And one of the things that we talked about is the trust fund. We talked a lot about the trust fund, what's going on with that, and what are the possible fixes for that. Because people worry about, what if Social Security trust fund goes broke, it goes down, what happens if that happens? And I made a comment. I said, a lot of times I don't get into the politics thing because it's pointless. Because I'll get questions. People will say, what do you think about this? What do you think about this person? I'll be like, I'm not going to make a comment. The markets go up under Democrats. The markets go up under Republicans. It goes up. Markets respond. Matter of fact, there was this thing about UK closing a tax loophole for the global rich. Now they're fleeing. Well, why are they getting out? Because they don't want to be where they're not going to get the tax advantages that they wanted. So they're going to move. What happens when corporations don't get the benefits that they want? They change locations. They decide that they don't want to be in the United States anymore. They move to other countries, or they decide they don't want to be in other countries because they're going to get a tariff against them, and they move back to the United States. That's what companies do. And that's one of the beauties of owning stocks is they're run by people, and these companies are run by people that want to make sure that they take care of themselves. It's like every time there's a tax law change, we're dealing with this big, beautiful bill, right? And I always kiddingly call this thing the Financial Planner and CPA Tax Act. And it's just simply because it is so good for planners, because people want to know what they need to do to deal with this stuff. And all our software programs, that's one of the things we've been getting is messages from their software providers. We got it up to date. You ready? You can come in and you can get your software and you can actually use this for deciding how to actually play this field. Because there are new opportunities constantly being opened up. That was a big, as a matter of fact, a topic of conversation about the taxation of Social Security. And people are asking me about that. Well, they didn't really get the tax exemption on Social Security, did they? And I says, well, they removed it for a lot of people, but it wasn't a direct correlation. It wasn't directly, it wasn't on Social Security necessarily, but they increased some deductions that you can get. And of course, not only the deductions, the $6,000 number that we've talked about, but also a couple $1,000s for charitable contributions. Which, for people that are in retirement that are under age 70 and a half and they can't do QCDs, being able to do a little bit of a deduction and actually deduct it for charities, that's a big win for charities too. So that has been, it's been talked an awful lot about, but the idea being that people earn money. They have provisional income, which is your income plus half your Social Security. And when it's been above certain thresholds, like for example, the threshold of $32,000 and $44,000 for married people and $25,000 and $34,000 for single people, and then all of a sudden you're getting more of your Social Security taxed. Well, by having additional deductions besides your standard deduction and being over age 65 and having additional money that you can earn and it not being subject to tax, that's kind of an indirect way of taking away some taxation on Social Security. And I think that was the purpose behind it. Now, this is speculation on my part. I have not heard anybody say this outside of me, not that nobody said it, but I think that the reason they did it this way is this. When you're looking at no taxes on Social Security, Remember what the big objection was in the media a few weeks ago. If you don't have taxation of Social Security benefits, it takes away one of the funding mechanisms for Social Security. In other words, when you look at how Social Security is funded, the trust fund is funded. You have the 6.2% on both sides, the person that works and their employer, 6.2% of their income is actually that's the tax rate. That's to fund Social Security. So the idea being, if you go into retirement and the trust fund is gone, let's say, that doesn't mean Social Security benefits stop, because you'll still have taxation on the income of people that are still working. Now, another source of money until it runs out is, of course, the trust fund, which is extra money that got pulled out of people's paychecks that wasn't needed right away. So that's the idea behind that. Now, the other source was taxation of Social Security benefits. When Reagan was in the 1980s, they had 50% up to 50% of your Social Security could be subject to taxes. So you have it's added to your taxable income. It doesn't mean 50% of your Social Security goes away. It just means it's added to your taxable income. Then you have 85% of Social Security above the other threshold. And, that's the $44,000 I talked about for married couples. And then you've got $32,000 for single. Now, if we're looking at that and saying, well, what if the taxation went away? That money was helping shore up the Social Security system. So taking away taxes on Social Security was going to be a negative simply just because it would take away that funding mechanism. And like I said, I hadn't heard this anyplace else, but I look at it, it goes, well, if they just add another deduction, then because Social Security is looked at as a separate financial system than our regular federal budget. When we look at our federal budget is funded by tax money. Social Security is actually a separate system. But, I'm wondering, and maybe that'll come out in a few weeks that's what they were talking about. I don't know. Maybe somebody's already talked about it. Now, I'll run into an article on it. But I think it's interesting how they actually went about it, because people say, well, why didn't they do it that way? Well, that was one of the big objections, was that. Okay, so they were talking about Biden and the CEOs. Remember I said just a second ago, I was talking about how CEOs and companies will do whatever they've got to do to make a profit when the deck's stacked against them. And I thought it was interesting, the conversation regarding what was happening before versus what's happening right now.
You're talking to Larry. It's like, I don't know, it's at 5:50 a.m. And I say, look, I have all my questions, and they're all worthless.
Oh, sorry, I hit the wrong one. That was that other one that I was talking about. This
Not
one.
to a man, to a person. They're all starting to come clean about Biden, saying that they had no relationship. There was nothing. It was really very, in many cases, frightening that that president didn't care at all about them. This president wants to speak to them. Do they agree?
Again, Jim, we had back-to-back 20%.
Now, number one, when we're talking about CEOs of companies, they want to get access to the government, be able to talk to people about what's going on, and they weren't getting any access. And that's basically what he's saying right there. And now, why would they wait to talk about that? Well, that's been a big topic of conversation, is that when you have a government in power, you do not want to talk against whoever's in power, because they could actually be vindictive and go back against you. So that's really what he's talking about there. But he said, now, his co-host here started to make a comment regarding this. And I want to hit that again. Now I want you to hear what he has to say.
The president didn't care at all about them. This president wants to speak to them. Do they agree?
Again, Jim, we had back-to-back 20% years, so none of that got reflected in stocks.
No. And I think that
Now, his point right there, he's making this point that none of this stuff got reflected in the stock market. None of this idea that the CEOs didn't get access to the president, or they didn't have any political access, didn't get reflected in the stock market. You had back-to-back 20% years. This is a little bit misleading, because if you look back at the market over the past, 3-4 years, you had almost a 20% decline in the stock market in 2022. Because when you have a 20% decline, you have to have a 20% positive to get back where you were. Yeah, because if you have $100 and you go through a 20% decline, what do you have? You got $80. Okay, so what does it take to get back to where you were, the 20% climb? Well, 20% of 80 is 25. So it takes a 25% increase in value for you to get back where you were. So you may have back-to-back upward movements in the market, but if you look at the market over that period of time with that 20% decline, nearly 20% decline, the average rate of return was actually the historical average for the S&P 500. It wasn't any greater than it had been before. So it's a little bit misleading, number one. The other thing that is a little bit misleading is you look at the market, the S&P 500 being the market in this particular gentleman's case, and you look at what actually created all of the upside return for the S&P during this period of time, and it was none other than just a few or small handful of tech stocks. When you looked at it, you'd have maybe 10 companies out of 100 making up 30% or more of the index. And then you have all of the gain in some years, literally all of the gain was just a couple of those companies. And that's because they weight the index based on the size of the companies. And when those huge companies go up in value a lot, the index goes up a lot in value. So that's my point right there.
Institutions like the fact that there was no other place to put money. We were the best place in town. There's a huge transference of $100 trillion going from the baby boomers up to the current people. And I agree. I mean, I always push back and say, well, yeah, but we made so much money. What's the deal? Maybe we didn't make as much money as we thought we could.
Now, that's a really good point right there. It's something I talk an awful lot about. When you see these types of things, you go, hey, everything's going just fine. The market went up. It did okay. But what's the lost opportunity cost? I often do this with investors in general. So I'm fine, Paul. Everything's going okay. And I said, how do you know? And they're like, well, I went up in value. I'm like, no, that's not the criteria. The criteria is how much did you go up versus what you should have based on where you were invested. And this is where benchmarking comes in. If I have a fund that goes up 20%, let's say, but the market that it was invested in went up 25, that's a 5% relative loss. And it is not unusual to see 2, 3, 4, 5% relative loss. And typically what I'll do with people is say, well, how much money was in there? 100,000. Well, that cost you $5,000. And they're like, whoa, wait a minute. I thought I made $20,000. And you go, well, you did, but it cost you $5,000 because you should have made $25,000. And this is why it's so critical to actually look at benchmarking. But he's talking about, in this situation, what were some of the things happening? What should we be seeing based on what has been happening around us financially?
I mean, I know it's obscene. We're so blessed. But when I talk to these companies, they're always saying, the big, beautiful bill, it wants them to build more. J&J directly referenced it. Say, listen, we're going to put a lot of plants up here. Plants that wouldn't be here, and because of the bill.
And you would think, listening to that, you would think that what would be happening based on that is that U.S. markets would be skyrocketing. And you would think that would be the big area. And it's so interesting to me that that's not the biggest returning area of the market so far year to date. And it's because markets are highly efficient. Many people saw that this might likely happen, and thereby what ended up happening with the stock markets and the markets that have, you would think would traditionally be doing really, really well, is this stuff was already built in. Small companies, for example. You look at U.S. small companies right now. Nothing going on. Now, it may be the hottest area of the market going forward. There may be something totally different that happens. But right now, not so much. If you look at why that's the case, it has to do with where small companies get money, where they borrow from. They have to borrow more money than large companies, and because of interest rates going up And then those issues being, that being a big issue, what's their cost of capital? What's their cost of using money? That has actually had an impact on them. I think it's fascinating. I think, and this is why it's so incredibly difficult to try to figure out where markets are going to go. It is so hard to do. And yet, why is it that the investment industry has been built around this concept of trying to figure out what's going to happen next? And it's because if you can beat the market, that you're investing in for just a short period of time, people think you've done it out of skill. And I'm going to tell you it was luck. But I'm telling you, a lot of people, once you have their money invested, they don't pay attention anymore. They don't look at the relative losses. They don't know that they're not getting the returns that they should be getting, just simply because they don't pay attention and they don't know how to benchmark. And far be it from the investment industry to teach you how to benchmark. I mean, that's something we teach everybody. I think it's critically important that you know whether your returns are what they should be based on what happened. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.